Hi everybody, welcome to another update on a stock screener. Somebody wanted me to take a look at Barrick Gold, the gold miner that everyone knows. It has been going down 10% from a year ago, 20%. Okay, how do we analyze Barrick Gold? It's one of the largest companies with operations, maybe 10 mines, 15 mines. How am I going to analyze this? This is too difficult to analyze. So the only thing that I can do is look at EV to free cash flow currently and try to estimate the NPV based on production growth. I'm not going to analyze each of these mines. That's impossible to do. So this is the most important chart. So here you can see gold production and copper production in gold equivalent ounces. So that's exactly the number that I need. And I will plot this in an NPV flow model. That's very easy to do. I also know what the all-in sustaining cost is. It's about 10% higher next year. And we know what the all-in sustaining cost is this year. So that's easy. NPV model is already done. I don't even need to look at all of these mines. So homework is done. We have this amount of shares. We have market cap 27 billion, 30 billion enterprise value, production going up in function of time. Capex is 900 million. Let's keep this constant. They will need to use Capex each year probably. All-in sustaining cost was 1350 going to 14 next year or this year. Let's keep this constant, probably going up, but just use it constant. Interest payments of 200 million per year, taxes 30%, and we have an EV to free cash flow of 20, which is a bit high. Okay, that's very high. Leverage is not that big. 1.4 leverage on a 5 times earnings basis. Break even is 1600. So if gold goes to 1600, then Barrick Gold will not make any money. But luckily we are at 2000, so there is some margin. This is 5 times free cash flow, 10 times, and this is 20 times. So a bit overvalued to me on free cash flow basis. Now, the thing is, you have two ways of valuing a company. Either you value it with the earnings, and this is the earnings valuation, which is overvalued, but you can also value a company based on the assets. So you have earnings power and you have assets. Barrick is very strong on the assets base because they have 20 plus mine life, 30 years mine life. So that's a great asset. And with that asset, they can keep on growing production, as you can see here. And I tried to extend the Excel sheet as long as I want because I'm not going to do 30, 40 years. That's too much admin. So 20 years, and then you can extrapolate yourself. I think 20 years is a good start. So what did I do here? I have production up to 31. As you can see, I don't know what will happen here. So probably constant, not going to rise that much. So I took 7 million ounces. Costs, I just take the same costs. Gold a bit up. This is not correct. This should be 1 US dollars to US dollars. And capex of 900 million, 200 interest that goes down if they repay the debt, 30% tax, and then you get these numbers. Revenue minus costs, and you get net income per year of about 1 billion, 1.5 billion. If gold goes up, can even go to 2 billion. And it depends, of course, on the gold price. If it's 2000, then it's only 1 billion. So 1 to 2 billion, is that correct? Yeah, 1 to 2 billion, depending on the gold price. That's the free cash flow. Is that a lot, 1 to 2 billion? On a 30 billion enterprise value, that's still a bit overvalued to me. PE of 20. Yeah, you can get a dividend of 2% maybe. What's the dividend on Barrick? 2%. So you get a 2% dividend. If you're fine with that, then you can buy Barrick Gold. But you can see already on this NPV chart with a 10% discount rate that 1 billion per year or 2 billion per year is not good enough for me. Maybe it can go to 3 billion when they increase the production, but it isn't going to the enterprise value on this chart. And you can extend this, but the longer that you go in the future, the higher the discount rate. And a high discount rate will make this curve flatten. So you are not going to get to this enterprise value even if you extend this. Now, if we use 5%, then that looks better, of course. 2%, even better. But we are not in a 2% environment. I think yields will go higher. We should see 5-6% at some point with inflation. So I use 10% discount rate and doesn't look good. I always use 10% for each gold miner at this point. Here, EV to NPV, most important chart, most important ratio, that's the enterprise value divided by the NPV. And this NPV is coming from all these cash flows that come in. 20 years of cash flow, of course, it can go to 30 years, but I'm not going to type all these numbers in. You can do it yourself. Eventually, you will get maybe to here, but it's still overvalued to me. EV to NPV of 1.5, that's a sell. Company above 1 is a sell, 1.5. I like to buy things with EV to NPV below 1, 0.3, 0.2 even better. 0.1 I haven't found yet, but I'm still searching. But Barrick Gold is not one of them. So that was Barrick Gold. So this one I have added here. EV to NPV chart. And let's update this. I think we have some more. And this. So we have the EV to NPV chart here. Barrick Gold is here, one of the overvalued ones, Newmont Mining, Barrick Gold. So I think GDX is really overvalued. People say that GDX is undervalued. I'm saying that it's overvalued because it's mostly these big gold mines and they are overvalued, as you can see here. The undervalued ones are here and should be bought. So that's where I'm focused on the undervalued mines. Then also look at EV to free cash flow. These ones are to be bought. These should be sold. So that was Barrick Gold. I think this will keep on dropping no matter where the gold price goes. Even if it goes to 2,200, it's still overvalued. And that's because they are already at 27 billion, giving only 2.5% dividend. That's nothing. So I'll see you in the next video, and now you know.